a tsunami. And I'm reading from the article that is coming. That's what at least one financial expert is saying. Charles Brown of CB3 Financial says,
one of the brilliant moves that Kmart has done is to partnership with Facebook in these e-gift certificates, so you can actually...
Of government mismanagement. Charles Brown is the president of CB3 Financial Group. He joins us this morning from Chicago.
Significantly dropping. Basically, this is the year of the consumer.
Believe that they're capable of managing anything?
Well, it's sort of like handing the keys to the chicken coop to two wolves.
Good evening, everyone. From Chicago, it's Thursday, July 16th, and I'm your host, Charles Brown, Portfolio Manager with CB3 Financial. We are glad you've joined us on this hot summer evening here in Chicago. From COVID to clarity, this is CB3 Live. Lot to talk about tonight. Our top three: coronavirus continues to wreak southern havoc. The southern part of the U.S. just is distressed right now. It's just crazy. Financial data continues to look strong despite COVID and election red state fears. Yes, that sounds political, and I'll get into that in that section. And we're not having the bull and bear case tonight because I'm continuing to review our portfolio performance. I think I'm going to do this a couple times a year, maybe 4, but I had not done it until last week. We have 4 programs. I covered 2 last week, and I'll cover 2 this week. So let's move forward. Want to remind you guys, if you have not subscribed, please subscribe and click that bell. See the little all there, and you'll get all the notifications for my Thursday night and Monday night programs. The Monday night program, if you guys have been watching that, is much shorter, but it does give you an update on how the week is starting. I do tweet every single day. Those of you that were on my old Twitter feed, that's being shut down. Please follow me on CB3_live on Twitter. I'll be putting information out every day, at least every day, if not sometimes intraday, when there is news to warrant that. And as I just mentioned, the Monday market mashup, you don't want to miss that. That's just a 2 to 3, actually last week was about 4.5 minute summary of what's going on in the market to start the week. Now, as you guys know, this is an educational program. And sometimes I have educational pieces that are not necessarily financial. And I learned a new word today. One of my daughters said she was going shopping for a trikini for her daughter, my granddaughter. So I didn't know what a trikini is, and maybe you don't know either, so I want to show you. This is a 2020 trikini. It's brand new. Didn't have this 100 years ago for the last pandemic, but that's the latest word to go in the English language, trikini. And there you have it. Okay, coronavirus. What is the latest? Guys, look at these numbers. So many in the government thought we were going to max out at 60 to 70,000 deaths. We're approaching 138,000. Although the deaths recorded yesterday, still not that many, but the cases, 66,000 new cases. And guys, it's because of the testing. I mean, finally, we're starting to ramp up the testing, and it's okay. A lot of this, as I just said, is explained by the 66% jump in testing just since I saw you last week. But the curve is flattening, all right? So 12 to 13% jump week over week, still below the recent numbers that we've seen, with the exception of those 3 southern states, Florida, Texas, and Arizona, and to some extent California. The cases are rising. We did have a little spike here. Look carefully at the chart and you'll see a little spike in deaths. But overall, the death number is good. I mean, there's such a thing as a good death number. But we're not seeing it rise logarithmically like what appears to be the second wave. My friend in Texas said, we're not in a second wave. We never finished the first wave, and that's true. Many states never saw this ebb down. They just stayed at a flat level. They didn't crest at all. So Some countries, though, because they were better prepared, look at Taiwan's numbers. Look at, that's the second week in July. If you can't see the blue line, it's because it's flat. I mean, basically nothing. South Korea had a spike very early in this, and then they flattened it out. And again, it's because they had experience with a pandemic 20, 25 years ago. A lot of their testing equipment was there, and they had, as they say, the fear of God in us. And our fear of God is 100 years old rather than 20 or 25 years old. So we're still playing a catch-up game. We're having definitely a second wave in some of these southern states, and actually more than half the U.S. states are seeing an acceleration in cases. I have my opinion on why that is. I've expressed it over the last few weeks. I'll say it again tonight in a few slides. The European nations, the EU, just not really seeing this second spike. And again, maybe it's because they're paying attention to what the protocols are. So what countries are at most risk? Those that didn't suppress the first wave and those that aren't building strong testing and tracing systems. Now, in the last 3 episodes, I've talked to you about the new occupation of contact tracer. And fortunately, we've got people applying for that, but it's just beginning. And so the US, Brazil, India, these countries are at the biggest risk for a second wave here. And I don't like reporting that. I really don't. On the good news front, Moderna skyrocketed this week. And if you guys remember, and that's the thing about recording these episodes, I did not buy Moderna about 4 or 5 episodes ago. I'm still not sure I would even do it today because after their huge gap, once it looked like they weren't going to be able to charge the money that they thought they were to recoup their R&D, pardon me, their stock dropped about 11% of that 15. But we have companies like Pfizer, BioNTech, Novartis, AstraZeneca. It's a real horse race. I mean, literally a horse race to get to that line to see who produces the most usable and systematizing, repeatable vaccination that can be sold worldwide. So interesting. You don't have to read all of this. I'm just going to show you this slide and then the next one. This is a paper that I'm reading, and what you're starting to see now, and again, I'm trying to read these for you so you don't need to, are, if you'll call it, intellectual or educational articles on which is worse, the cure or the disease. In other words, should we have shut down? Should we shut down again if this second wave reaches a really critical stage? And I don't necessarily have a strong opinion on that. I'm sure I will have by the time I've read some of these. So over the next month, I'll be reading some of these papers that are coming out at the scholarly level and see what their analysis is, evaluate their data, see if it's, in my opinion, politically motivated, or if it's really just good, honest data. And that's what I'm hoping it is. I said this last week, but there are just some times when there are months that when decades of transformation happen. And by that, February to July, it looks like decades of transformation have happened. We have seen weaknesses in the medical system here. We've seen strength in some of the Asian countries. We've seen what some in this country believe is massive deception from how this started, when it started, what could have been done to spread it. But we are learning a ton about what to have not happen the next time. So months have produced decades of transformation, and that is this time. So now I want to hear from you guys. Is the continuing southern U.S. COVID-19 spreading worse than last week, or is it getting under control? What do you guys think about that? Now, we got about a 25-second delay here, so I'm going to pause for a minute and let you guys answer that. I'm going to check the feed, see if I've missed anything. Hey, Nellie, how are you from Georgia? While you guys are answering this, I'm going to show you this little comic that I think is pretty cool. You may not. But so the wife says, did I get fat during the quarantine? Husband says, well, you never were really skinny. Time of death, April 25th, 2020, 11:23 p.m. Cause of death, coronavirus. Now, there's been all kinds of joking about how many people are dying of the coronavirus or with the coronavirus. Well, this is an example of someone dying from the coronavirus. All right, what do we have here? Hey, Karen, welcome. Nellie, we got a C. All right, let me go back to the question here. No, it had to happen. All will be okay. That's good. Karen, yes, I think the spread is worse this week, and I'm more concerned. Okay, I get it. A lot of people are. All the reporting numbers are suspect. Now living in Florida. Okay, yeah, Charles, you're right in the hotbed there. Feel free to, say something in the chat. Hey, Dr. J from Ohio. I think we got all 4 time zones now, guys. That's great. Okay, any more answers here before I go on? So we had a technical problem with my guest tonight, and I'm real bummed by that. We haven't had any technical problems, and this is episode 19. But I'm going to have to go on because my guest isn't here, which means you guys get out early. So, and Charles, you're waiting on more news to decide. Okay, got it. Anybody else? All right, let's go forward here. So the U.S. economy, guys, the numbers are still good. That's what I said in the prelude here. The NASDAQ up 16.6, the down 10, really down 11 for the year. S&P really trying to get positive. 2 days ago, it closed down 0.1% for the year. And it just couldn't get above positive, and the Russell's just getting whacked all year. But the good news is the NASDAQ, the NASDAQ is really pulling everything up with it. And why is it? Facebook, Amazon, Netflix, Google. It says Alphabet, but it means, Google, obviously. Tesla, DocuSign. There are plenty of tech stocks in here that are pulling this up, and that's why this looks this way. So why is the S&P not doing any better? Well, actually, the S&P, I'm sorry to show you a techie chart here, but this is important. You see that red line just crossing above the blue line? Well, that is what's called a golden cross. The red line crossing above the blue line is the 50-day moving average crossing above the 200. The last time it happened was over a year and a half ago. And that's a positive. Now, the NASDAQ did this weeks ago. But with the S&P joining it, what that tells me is, and I'm trying to, again, get you guys comfortable here, many people thought, well, the NASDAQ's just jumping out in front and it's going to turn around behind it and say, oops, the S&P and the Dow and the Russell are back there. I'm way too far ahead and then everything's going to sell off. Well, actually, the S&P has now crossed over into bullish territory. Now, it was technically in a bull market because it still closed above the 20% loss down to March 23. But this is a good number. It's a good number. It's a good chart. For those technicians of you out there, and I know there are some. Empire State. The Empire State is New York. And their manufacturing index, the survey was for 10.0. The actual is 17.2. Look at that little red dot, guys. That's higher than it was in parts of 2015, 16, 17, 2014, 2011. I mean, what an enormous move. That means there are manufacturing orders coming in. Okay, this rebound has a 7.2 surge after a 3.8 increase in May. If you see the chart on this, normally we're looking at like a 0.3 to a 0.4. We get excited about that. But these have numbers to the left of the decimal point, so that's really positive. And again, all of this is sourced. If you guys play this back, this video, you're going to see the sources: Labor Department, Commerce Department, Federal Reserve. I'm not just making these up. These are real numbers, okay? Small business optimism. So now this isn't actual production. This is a sentiment indicator showing the optimism of small business leaders. And look at that red dot. Again, higher than 2017, 16, 15, 14. Ricocheted back above the zero line after being down minus 43. That says to me that the majority of small businesses believe this is an aberration. This is not a 2008, and it certainly is not a Great Depression by a long shot. June retail sales 7.3 versus 5.0, which is what the briefing consensus was. Now the prior month was up 12.4 because that was the first ricochet. But still, a 7.3 increase. I mean, we're going to take everything we can get to get back to normal, and that's a positive number. You may not be able to see all these numbers, but just look at the red bars. This is industrial production and manufacturing production month over month. Again, this is data that I wouldn't ever put, and I've been doing these speeches, fireside chats, those of you that have been to those, for 12 years now. I would never use these numbers because there's so many other more important numbers to talk about, and you can see that because the blue lines, except for the last 4 lines there, barely move at all. But look at what's happened. 2 down months and then 2 months ricocheting right back. That this economy does not want to stay down. That's what I'm seeing. This is not your granddaddy's depression. I should have said recession, but the builder confidence, okay? The highest consumer discretionary category as far as expenditures is housing. So the housing index was up 72 versus 60. And you don't even need to remember all these things. Just remember that the number on the left is bigger than the number on the right, okay? Single family home sales, 79 versus 63. Future sales, 75 versus 68. Prospective buyer traffic rises to a 58 from 43. All of these numbers, with the left number being bigger than the right number, are positive. And it's in the building sector, it's in residential sales, and that's where the big money is being spent. I mean, sure, we want shoes and dresses and purses to rise too, but when housing is, it's really huge. ISM non-manufacturing. So we talked about manufacturing, we talked about industrial, we talked about small business sentiment. This is non-manufacturing, okay? So what's the index doing here? Again, you don't need to remember the numbers. Just remember where the little red ball is. It's above 55, which is higher than it was in a portion of 2017, 2018, 15, 14. It just leapt back into strong territory. Anything above 50 signals expansion, and so we've gotten back to that very quickly. Now, I don't know how much you can believe this China data. Candidly, it can be kind of frustrating when I see data from China. But the reality is China now is saying that their second quarter GDP, remember, we're in July. This is the first month of the third quarter on a calendar. We report our GDP. We haven't done it yet, but we will. China has reported theirs, and they actually grew. Their economy grew. Now, we're not expecting to see positive GDP until we start getting reports in October, but China already has. And if that's true, then that means that they have pulled through this pandemic with the same sort of trajectory that I'm showing you in these earlier slides. And that's a positive, again, if you can trust the data. If it's not true, then their exports are going to be hit if we have a prolonged recession. I don't see that happening. I'm just not seeing it. We have a tale of 2 markets. I said this last week. I'm saying it again because it's so important. We simultaneously have a bull market and a bear market. It just depends on what sector you're in. And that's why people that say, oh, I'm just going to buy the index, I'm just going to buy an ETF and just ride it out. You can do that. But you see what's happening now. If you just bought the S&P 500, you'd be down for the year. And you saw our performance last year, and I'm not touting our performance. There are other people that are having a good year too, and some having a terrible year. Kind of a bull and bear market for money managers, portfolio managers too. But the truth is you have to follow where the money is moving. It's not a kindness thing or a sentiment thing. It's just math, guys. It's just math. So the stay-at-home stocks, we're calling it. This is the bull and bear. The stay-at-home stocks have done well. The airlines, the cruise lines, the symphonies. I just got an email 4 hours ago. Bummed me out, guys. The Chicago Symphony Orchestra has canceled the first half of their season. No Christmas, no New Year's, no autumn, nothing. No chamber concerts. I mean, done. And yet, look at Twilio, up 145%. Up Spotify, up 112%. Tesla, Square, Snap, DocuSign, PayPal, eBay. We have at least half these stocks between SG and CG for the reason that that's where the money is going. And you just got to do that. With the S&P, and you saw this last week, only 24% is in technology, 11% in communication services, 11% in discretionary, because they have to even out. I mean, if you're going to own the largest 500 companies in America, you're going to have a swath of 11 sectors. There are 11 sectors. If you're in my programs, and some of you guys online are clients and some of you guys aren't, I'm not in 11 sectors. I'm in 5. There's 6 I wouldn't even touch right now. Okay? Probably not accurate because one program I think has a financial, but there's at least 4 or 5 that I'm not in any program. And that's because I don't just want to be in something just so I can say I'm in it. I'm not required like the S&P 500 to do that, all right? Let's ask our second question here. What's the significance to you of this week's economic reports? I could have brought you more, but I wanted to just give you the best of what I saw. I try to make it balanced. There were no negative economic reports. There's certainly negative COVID reports, and I brought those up. So what do you think? Answer A, they are muted. These economic reports are muted by Wave 2 news. They're the calm before the storm of a really bad second wave. That's something I haven't asked you before. Or C, human nature to be negative. And I believe the best is yet to come for our country. That's kind of the optimistic answer. And D, I don't know what to think. So I'm reading through questions here or comments. Anybody want to answer this? I know you're about 25 seconds behind me. And I see, Nellie, you're agreeing with Charles Todd. Yep. Can't believe anything China says. It's too bad. I wish we could. Wish we could. Believe the best is yet to come. You guys know that's my position, but not everybody has that. And it's okay. We need a balance of opinions here. Anybody else? What's the significance? Which of those answer? Alice, you're also a C. Good to see you. Okay. Anybody else? Karen, C. Oh, Karen, good. Good, Karen. That's good to see. I know you've been concerned about the market a little bit, Karen. I've been following your sentiment. But yes, when you look at the data, guys, but it's okay. Don't be reticent. I'm not going to blast you if you put A or B. All right, let's keep going here. Let's keep going. So I've said this before, but you just got to stop believing that the economy is the same as the stock market. I believe that the stock market in the U.S. in particular is the best forward-leading indicator or leading economic indicator in the world. There are trillions of dollars at stake, and these accounts and these programs are managed by the smartest men and women on the planet, in my opinion. And I think that this market gets it right most of the time. When they had a shock surprise from COVID-19, they didn't waste any time selling like crazy. Big players, market makers, institutional traders, Goldman Sachs, the biggest players out there, they sold. We held on through that because we saw that on March 23rd, the VIX hit a lifetime high, the panic indicator. And we all know that since then it's been mostly straight up. I've gone on record before, and I'm going to do it again right now. We will never see the March 23rd low again in our lifetimes. We won't. And that's because it was completely factored in. We got some more. Hey, Kay, I didn't think you're going to be able to make it. Doc, you got a D there. Okay, got it. Waiting for more data. That's fine. So the stock market is confusing a lot of people. News is bad, pandemic, stocks should go down. Why? Because the economy is not the market, guys. And I won't hit you with this every week, but I just think it's important. I want you to leave this broadcast tonight with the optimism that the news that you're seeing and the market performance that you're seeing, if you're clients, you're seeing this in your accounts. If you're not clients, whoever's managing your money, I hope has made money for you this year, because even with 3 of the 4 major indices down, if whoever your manager is following the money, you'll be up by something. We're up by a lot more than something. All right. So what do we have here? I usually finish this section showing you the percentage of stocks that are beating earnings. So this little graph that you see kind of at the end of this module shows the percentage of stocks that are beating their earnings estimate. Well, that's at 77%. Last week it was 83. Now this is still very early in the earnings season, right? It's the 15th. And this runs well into late August and even some in September. And then it starts all over again in October. So we still don't have any reports from energy, which we know will be awful, materials, real estate, communication services. And so every week that goes on, I'll bring you more of these. But 77% are beating, only 23% have blown it. Consumer discretionary, not quite as good. The point I'm trying to make is historically, this number has been between 75 and 78%. And we're right there And this is for second quarter. Remember, we went through this back in April, all right, when we started getting first quarter numbers. And we're doing better now than we were doing then, by far, okay? So, as I said, no bull and bear tonight because I want to review the other two programs that we manage. Some of you guys are in these. If you're one of our clients, you'll want to see this data and follow it. If you're not, that's okay. You can at least follow the methodology and how we do what we do, okay? So this is strategic growth. So we have two growth programs. We have CG, which you saw last week. That's capital growth. And this is called strategic growth. They both are high-octane programs, meaning they are 100% stocks, and their goal is growth. I don't care about dividends. I don't care about turnover, meaning I could trade. This particular program doesn't trade more than 4 to 6 times a year, but it's rebalancing throughout the month to keep, to keep all the stocks at the proper allocation. But I'm looking for here the highest earners that have consistently had relative momentum that exceeds what their industry group is doing and what the S&P 500 is doing. For the year, you can see the blue line has tracked the market through the downturn and then really pulled away. So up 18%, 18.5% roughly for the year, and that's as of last night. So if you compare that to the benchmark, the S&P is down 0.13, actually a little bit more today, but I obviously can't get today's data because it hasn't closed yet. That's 1,854 basis points on a relatively simple strategy that's monitored every week and adjusted as necessary. Very different strategy from CG, and my most aggressive clients have both CG and SG accounts. My really larger clients have CG and SG, but they also have my more conservative programs too. So if you guys just want to talk about asset allocation, are you allocated properly? You know how to reach me. The contact data is there, and I'm happy just to talk to you. It doesn't cost anything, but I'll show you how I got these results. If anybody wants to dig down into it, I'll do that too. I showed you this last week. People say, well, what are you in? Well, what I'm in is important, but what I'm not in, I don't hate to hit prepositions like that, is just as important. So it's not the stocks in which I'm invested solely, it's the stocks in which I'm not invested. So let's look at the green here, cyclicals. Okay, I began with an 18% weight. I bumped it up 1.5%, which is higher than the S&P 500 because I see cyclicals as the place to be. Okay, I'm going to skip the red one here. Healthcare, I'm at 8.6. The S&P's at 13.9. I'm at 17. I took a huge increase in healthcare when it became obvious in February that that's where the technology was headed. Okay, so I'm now ahead of the S&P in weight by 300 basis points. And technology, I showed you this in CG last week, and it's the same in SG. 26 versus 22 is how we began the year, but now we're 40 versus 26. If technology is the best performing sector and I have a 40% weight and the S&P has a 26% weight, guess who's going to win that? That's kind of like a team going out against an NFL team, but one team has 11 players and the other just has 8. Okay, so I want to come back to this consumer cyclical. I started the year with 0. The S&P had 7%. I now have 0. And the S&P is down to 6.7, which means somebody dropped out or they rebalanced. But I'm not getting weighed down by an underperformer. Okay? It's really important to understand if you want to beat the market, you have to be where the money is, and you have to not have money where the market isn't. All right? Sorry for the double negative, but that's the best way to say it. Now, here's the challenge. We have 4 programs. This is the only one that has not beaten its index. I'm going to show you why. So GI is our most conservative program. The blue line, just like it is on the other charts, is how it has performed. It actually beat the market, although it went down farther than I would have expected, but it beat the market for the most part. But then right about here, okay, right about April, you can see that the S&P, the value line, the foreign markets all just went crazy, and GI could not keep up, and that's because it's a conservative program. It has conservative stocks in it. I want to drill down into this and show you what this means. So you can see the blue line here. That's the value of my GI account, technically Alice's, but ours. Again, you guys, if I haven't said this enough, we trade everything that our clients trade. Alice and I have 100% of the same investments that our clients do. We have different weightings because our risk tolerance is different than your risk tolerance. And I'm going to kind of make a pre-announcement now. We're working on a website update that within a month, you guys are going to be able to go online and do this risk assessment for yourself. It's going to be really cool. Really excited to show you about that in August. But you can see here the blue line, once the market just caught fire, all those mega cap stocks, the Teslas, the Facebooks, the Amazons, the Microsofts, the Apples, we just don't have those huge names in GI because what's called the beta, they're just more volatile, they're riskier. So it has underperformed. It has outperformed the Dow, which is really its benchmark. So you can see on here that overall we're down 533, or a little over 5%. The Dow, as you saw or might remember at the beginning of this module, was down 10% for the year. So we are beating the Dow, which between the Dow and the S&P, that's somewhere where the benchmark is for GI. This program is actually longer term, much more conservative than the two growth programs, and more so than DG, which we showed you last week, that was also positive for the year and beating the S&P 500. So as we transition, next week will be the 20th episode, but as we transition into August, inevitably, our election is less than 4 months away, and politics does play a factor in our financial assets. Different sectors, depending on who they think is going to win, who the market players think is going to win, can perform more strongly, less strongly. Healthcare may be more threatened if Joe Biden's elected, okay? Tech may not see the incentives if Biden's elected or if Trump is reelected, all right? So I wanted to show you this map, just kind of look it over for a little bit. And this is the percentage of Americans in each of these states that voted. It's under 50% in many states. Now, since 2018, it has probably come to your attention that we have more acrimony here in America than we did even in 2018, and we had tons in 2016 when President Trump was elected. So inevitably, I will be discussing politics beginning August, still talking about COVID, but we're going to head right into the November election because obviously if there's a big shock in the market, you may not remember, but the market went limit down about 10 p.m. Central Time the night of November 6th, I think it was, the election in 2016, limit down. It shut down when it looked like Donald Trump was going to win. And then the next day, it completely turned around. And the rest is history, isn't it? So let me take a few questions here. What else do I have? And then I will move on from there. I know it takes a few seconds for you guys to catch up. I saw you guys got answers here. That's good. As they say, 2020 is the longest decade in my life. Yes, Kay, I hear you on that. Yeah, the appendage to that, 2020 has been the longest decade in my life, is my car's getting 3 weeks to the gallon. Just crazy. So you guys got any questions? Anything you want to type in now? Because it's going to be a little bit of a shorter show. You know, normally I allow 8 minutes for the interview, and we again had a technical problem. I want to remind you to subscribe. Again, I'm trying to regularly post now videos Monday and Thursday. Who knows? It may increase. Things are moving pretty fast. I mean, we could have an election where there's now, the Supreme Court comes in to have to rule whether it's going to be done with absentee ballots. I just don't know. But I'm pretty sure there's not been another election like this in U.S. history. You can go back in history and see what was there for 1918. And of course, we're in the middle of World War I during that. It's not like we've never been through this before, and we're not in a world war right now. So let's realize that. The tweeting, as I say, I tweet every day about 5:15, sometimes intraday if something's important. If you guys have a Twitter feed, just subscribe, CB3 Live. I'm right there, okay? And I'll send it to you. Do I see negative interest rates from Charles? I do not. Jay Powell, the chairman of the Federal Reserve, is very much against it. The concept, and I've talked about this before, but I've got the time tonight, negative interest rates, folks, means when you buy a bond and it has a negative yield. So let's say you buy a bond for $100. They don't sell them that small, but you buy 100 and you have a 3% interest. That means if you buy a 10-year bond, every year you're going to get $3 in interest, okay? So the problem with negative interest is they literally have a yield. Let's say it has a yield of minus 1%. That means instead of you getting, you're not going to get any cash, okay, for interest. And instead of you getting back your $100, which is what they're supposed to do at the end of a loaning period, you're going to get back $99. They're going to keep $1 and not pay you any interest. And that's what's happening in Europe right now because that's what they're doing to attract money. That's what they're having to do. The European Central Bank, Christine Lagarde was just on today saying, yeah, I don't see any changes. We're going to keep doing this. It's working for us. Well, it's crazy to have negative rates. It's crazy. It makes no economic sense whatsoever. And of course, the market determines this. The Fed can influence it. But if the price of bonds continues to rise and rise and rise, it eventually, just like crude oil, remember that, guys, back in episode 9, I think, where crude oil went negative? So that's my answer. I don't think we're going to have negative rates. Why do you think the market went down and then up when Trump was elected? So the market went limit down because nobody thought that Trump was going to be elected. There are plenty of people now that in the rearview mirror say, oh, yeah, sure. Yeah, we knew he would. I'm checking my messages here, see if I've got anything. Yeah, they went they went nuts because they thought, oh, it's Armageddon now. You know, they thought that the economists that had predicted it was going to be Armageddon. But then I guess they convened for about a half an hour and realized, no, this is probably going to be good. It means that, especially because as evolved over time, and again, I've got more time tonight, so I'm taking a longer answer here. The Senate was going to be Republican, and the House is going to be Republican. So when you see all three houses with a very pro-tax relief president, everybody just realized, gosh, this is not limit down. This ought to be limit up. And that's what happened. That's what happened, Ellie. Good question. Karen, if we have a pullback, what percentage do you anticipate? No way to know that. I mean, it's just, how would we know? It depends on what happens with COVID. It depends on what happens with, if these numbers keep showing Joe Biden really has a chance to win. I mean, why is Donald Trump campaigning in Georgia? We have a Georgian on the line here tonight. Why is he campaigning in Georgia? Georgia should be a red state. But I think he's quite concerned. And the market is not going to like a Democratic president who at that point would undoubtedly flip the Senate. Senate's only a 2-seat majority, 52 to 48, 4-seat, but plus to the plus side. It's just not going to be positive for the markets. There's no way. Why would anyone buy a bond at a negative rate? Because if you have a mandate to have a certain amount of money in fixed income. Now, these are not individuals. You and I are not going to go do that. But huge endowments, banks, entities, universities that have to have a certain allocation in fixed income because they're not allowed to be in equities because they're too risky, will say, okay, well, if we're going to go through a deflationary period, at least I'm going to get back 99%, you know, as opposed to make 1% or 3%. It seems like crazy logic. If you guys have an interest, let me know, and I'll do a little expository on negative rates next time. But I just don't see it happening here, and I'm glad. I don't see eye to eye with Jay Powell on everything, but one of the things I do see eye to eye with him is that he does not want the Federal Reserve in any way, shape, or form promoting negative rates. So anybody else? Anybody else? Other questions? All right, guys. Well, you see the contact numbers. Always end with this: for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. That's 2 Timothy 1:7. 2 Timothy 1:7. We have not been given a spirit of fear, but a spirit of power, love, and a sound mind. And we're going to need every ounce of that as we head into the late summer and the fall with COVID, an election, and all kinds of challenges, it remains my deeply held belief that we will not only survive this pandemic, but we will emerge a stronger nation. I really believe that. I can't tell you how much I appreciate you guys being here. That's our show for Thursday, July 16th. I'm your host, Charles Brown, Portfolio Manager with CB3 Financial. We appreciate you asking questions. We appreciate those of you that are clients staying with us. Those of you that are not clients, we appreciate you tuning in just to see what we have to say. We hope that we bring you optimism. My pledge to you is I'm going to continue to do that throughout the summer, all the way through the election. From COVID to clarity, this is CB3 Live.